I want to start with the same place I started with the Neil Boustry this morning. A lot of people in the tech world know Silver Lake. A lot of people who are not in the tech world would not. In the same way, it's the same situation with Workday. People would know KKR, which is a teeny-weeny tech investor, compared to Silver Lake. Give us the overview, including the history, real quick, if you would.
Real quick, and I'll do one thing. This is a special conference for us. 3 years ago, as I walked off stage here after Adam interviewed Ben Horowitz and I after we sold Skype, Michael Dell and I talked for the first time there, and it sort of led to our buyout. So
we love that story, including the fact that it was disclosed in the Dell proxy. That you met at a technology conference.
So we were founded at the end of '98. We've been around now about 16 years. We're up to 26 billion. Our simple objective is to be the best risk-adjusted technology investor in the world, operating outside the venture class. We do everything from large-scale buyouts to minority growth investments, so Dell on one hand, Alibaba on the other. And the strategy is really quite simple. We're investing for growth. We're backing great management teams. The format and archetype of our investments are structurally flexible. And we're trying to help companies be better, but being almost a counselor, consultant, support, and then bring operational expertise to the businesses. What has been different for us than other guys who you would think of as traditional private equity is our average leverage level in these quote unquote investments is about 3 times debt to EBITDA. And we've borrowed over $150 billion, but we've never defaulted on a loan. It's all about technology investing. What is unique, and I think in sort of unprecedented time in history, and it's sort of accelerated over the last 3 to 4 years with all of these trends that are colliding, is our market opportunity keeps getting bigger. So when we were started, we were a sector specialist fund, and there were media funds. Well, the number of cable companies you can buy around the world is actually down a few. By definition, today, almost every company in the world, in one way or another, is now a technology company. It just turns out the skills that we have, both as investors and operating, are applicable in other companies that people would say, well, that's not a tech company. Well, actually it is. Like you had Ari up here yesterday, and we own 50% of that business, or we have a big financial services practice, or we've invested in healthcare. Increasingly, these companies are not just using technology to manage the operations of their business, but if they don't implement technology to run their businesses and generate revenues, they will die.
So keeping high level, Henry Kravis was very clear yesterday. Dan asked him, why haven't there been any big deals recently? And his answer was, because the banks are finding it harder to lend. Is he wrong? Do you disagree would be a more polite way for me to ask the question?
Yeah, I think so. We're finding that there is plenty of capital available at relatively attractive rates. One of our portfolio companies, Avago, where we invested last year, and this where the structurally agnostic matters a lot, we invested $1 billion in a minority, but it was a previous portfolio company of ours. We'd partnered with the CEO. They used the money to buy a company called LSI. Came time, they bought Broadcom. And there was a lot of money available.
And excuse me, when you say structurally agnostic, you're saying you don't have to be in a control situation.
Don't have to be in a control situation. We're willing to own, we're willing to own 3%, which is probably what we own of Alibaba today.
Speaking of Alibaba, tell everybody, you invested at Alibaba, compared with this current stock market price, what was the valuation when you invested?
It's about blended $35 billion market cap. So, we're up 6 and change-ish around it.
6x and change-ish.
Yeah.
That's despite the stock being down dramatically.
Yeah. It's a very special business. We think Alibaba has a chance over a 5 to 10 year period to prove out to be something that feels like Google or Facebook. You've got a management team with an infinitely long time horizon. They've got a demonstrated track record. We were attracted to, as Dan was talking about, real companies with cash flow. This is a business which generates a lot of cash flow, reinvests a lot of cash flow for growth, and they're making a bunch of huge bets on new market opportunities while having a core business opportunity that reminds us of what Google search kind of went after around e-commerce.
The last time you were here, as you mentioned, we talked all about what I think was one of Silver Lake's and I think one of your biggest successes to date, which was the Skype transaction. I want to talk about what I think is your biggest investment right now, or at least one of your two biggest investments, is Dell.
Yep.
We haven't heard a ton about Dell for exactly the reasons that Michael Dell anticipated when you did the transaction. They're not public anymore. First of all, tell us what you can tell us about how Dell is doing.
Sure. You know, these are where facts matter. So we've gone private. Michael's actually written about it. We've stayed purposely quiet. Companies are about CEOs first in our view, and management teams first. Subsequent to going private, we've paid down a fair amount of debt. We're one notch below investment grade now. We've increased the investment in the business quite substantially in terms of R&D and sales and marketing. We're in the process of hiring thousands of salespeople. In the old days, in that we had a down Q1, you would have a company that would say, oh my God, how are we going to make the quarter? How are we going to guide for the rest of the year? And a lot of the sensitivities actually around the Windows cycle, Windows new release. It's irrelevant. We're long-term partners with him. We are obviously in the money. There's stories that have been written about how in the money we are, but if we have a $5.5 billion equity account. We've paid down a good chunk of debt. It's not publicly disclosed, but if you get a double notch upgrade, you've got that. There are many high growth assets inside the business that have sort of potential well beyond the Dell being part of the Dell mothership, that are potential spin or combination candidates where we can work with Michael, again, taking a very long-term view around portfolio optimization, not selling them, but actually unlocking value. I think what Mr. Tucci's done with VMware is a very good example of that, where you can take something that people don't fully understand buried in the portfolio, unlock it, and have a partnership with the mothership.
You have VMware and Pivotal, so this EMC
Federation.
You see a Dell Federation potentially.
And Michael has businesses like that. We have a company called SecureWorks, which is a great cybersecurity asset. Cybersecurity is obviously quite hot. We have a cloud integration software business and a platform called Boomi, and others that are like that. Again, where they're inside of Dell, but have extraordinary growth potential. And we view Michael's business as a platform company. Again, if you take a long view, where what gets undervalued, particularly in enterprise technology, is how hard it is, and Anil could talk to you guys about this, or Mark Benioff, to build brand, scale, and ultimately distribution across hundreds of countries globally, get the infrastructure set up and the ability to sell in. And that value, the goodwill of all that, gets mispriced. In markets like these, the enterprise technology assets trade at very high valuations. In other markets, they trade lower.
What's Dell's time frame for doing some of these transactions that you referenced?
We're not committed to doing anything at this stage. I just use it as examples of deep high growth assets that are inside of the business that may have potential to unlock value. And as you think about how is the deal doing, the deal's doing great. We're generating a lot of cash flow. The equity's appreciating. The management team doesn't have to deal with the quarterly pressures and the earnings pressures of what that is. We're taking a long view around investing.
But you do have a quarterly plan. You are on the board of directors. You do have a quarterly review of the business. True?
True.
Have they had what would have been considered previously a missed quarter in the time that you've been involved?
We have. This is not public, but I would say we expect this year, vis-a-vis the financials that we've given, and actualized last year, we expect this year to be a very challenging year. Again, the company's caught up in a Windows product cycle, which is out of the control of the business. And you can see this in the reporting of large public companies.
Hewlett-Packard, for example.
Seagate yesterday, Intel, et cetera. Where for us, again, you have large, and I won't name them, but you can see large, big technology companies talking about big layoffs That's not a priority for us.
Interesting.
Because again, you can take a different view around managing the asset.
And so, Egon, lastly, on Dell, I think Michael Dell has been public with the fact that he is really enjoying being a private company. And one would deduce from that he'd like to stay private as long as possible, and he's not an old man. How do your limited partners get paid in that scenario?
Well, look, there are many examples of us owning businesses for over a decade. The commitment that our organization and partnership has made to Michael, and Michael's made a lot of people money along the journey, is we would help him make it a better company, the one we invested in. We saw value. That turned out to be quite contrarian. Many other people in our industry and public shareholders and analysts.
And journalists.
Yeah, it was as well covered a company as you could find. Thought we were crazy or overpaid and didn't think we did a good deal. Now, notwithstanding that, we've committed to Michael that we're going to help him make this a better business and try to make the investment decisions around unlocking that. Ultimately, how we exit and return money, you've got many options. You've got dividend recap. Michael ultimately could buy us out himself. Michael's got the ability from the cash flows of the business, of which he's known to own 3/4 of the equity of the company, to be able to finance us out on that time. My own horizon for this, and it is different, it's very similar though to how I think about working with Ari and Patrick at WME, is we don't have a horizon. Like the exit and the monetization of this thing isn't the goal in and of itself. It's like going public. It's just a step along the journey. What we're focused on with him is really trying to unlock the embedded intrinsic goodwill of the company, this value around scale and brand, and taking advantage of this. One of the observations that we have, Avago is a great example. We bought a company from Agilent for $5 a share, exited it in the mid to high 20s, bought back in at 48, now it's 130 and change. If we had held our best winners, Skype, you heard of this thing called Snapchat, Seagate, up 40x. It's not that we get paid to invest and exit, but ultimately it's a privilege when you find a great CEO who's capable and knows how to invest capital and can build a company and can scale. And if you ride out multiple cycles, because tech investors come and go, and especially go when the world gets tough and things get valued differently. And what we're concluding, and it's an ongoing evolution, is we'd rather give more money to people that we like and trust. They just turn out to be better compounders of money. We don't have the Berkshire Hathaway model, but we're feeling it as we go through this. And when we get into things and we make investments now, the psychology around our investing, while we may have things where we exit in relatively short periods of time.
Like Skype.
Like Skype, 2, 3, 5 years, that we transform and we realize the value and we decide on a risk-adjusted basis the time's right to exit. We're getting into these investments and the companies that we funded over the last handful of years, taking a much broader view of how it fits into our portfolio, brand, our ability to help. Do we really want to get married to the CEO institutionally? Because it's not an individual, although it's easy to associate people with transactions. It's really a great partnership of folks who are working together to create this value.
And so I take it from your answer that there's no point in having a long conversation about what your exit plan is for WME IMG, because it's a very similar answer?
It's a very similar answer, but the beauty is what we're not talking about is it financially distressed? Did we over leverage it? Are you investing for growth? The reality is when you have a really good company with a lot of options, you have options. Would we ever take WME IMG public? Sure. The guys are totally capable. We have a world-class management team. Chris Liddell's been a public company CFO of GM and Microsoft.
This is the CFO of WME IMG.
He can handle the job with his eyes closed. So, yeah, of course, these are interesting things to talk about. But again, we're not going to sell a share at the IPO. Blake spoke this morning at GoDaddy. We took the company public. We issued primary. We were so disappointed in the price of the IPO, not that the bankers did a bad job, but to this point that Anil made, the public markets are valuing companies different than private markets. We actually took money out of our fund and bought common in the IPO and invested more. Thought it was too cheap.
Really?
So again, if you have a long horizon, the IPOs are just a step in the journey, and then you ask yourself a pretty fundamental question: why are you going public, and what's the purpose of it?
Who has a question from the audience? I have a few more, but I want to see what yours are. I know Dan Primack has something that he wants to ask, but maybe he's not in the room at the moment.
Good.
You say good because he's not going to be as nice. Yeah, one right here. Just wait for the microphone, Brian. Thank you.
Hi, I'm Brian Stengel with Perella Weinberg Partners. So Silver Lake had its genesis as a technology private equity firm, as you mentioned. But when you look at WME, for instance, that's a content-focused company. So how do you think about content and media, colliding with or merging with technology as you think about other assets that you're out looking at or entertaining doing a transaction with?
Look, it would be naive to have a fully baked answer. What we observe is that as we move upstream, as Ari talked about yesterday, from representation to content ownership, the understanding ability to deliver it online, that functionality is pretty fundamental. It's product development, product marketing, go-to-market. We've done that in many other companies in much higher stakes way, whether it's a Skype or other things like that, even GoDaddy, and building those platforms. WME IMG itself, what's special is every time there's a dislocation of a new technology, radio to television, film, radio, et cetera, you create an opportunity for the talent to talk to the audience differently. And what you're observing is the talent now has more power than ever, and the talent wants to talk direct. And it's coming in many different shapes and forms. That's one thing. The other piece of it that's very fascinating that we think with the combined platform we're well positioned is, as the owners of content think about other ways to distribute and how to break up their rights, we've also created a business which is, again, well positioned. If you're not a technology investor, you may not see all of these elements, and then also work with the team to help deliver the capability of these assets. Media is easy, healthcare more difficult. Financial services, our partner Mike Bingle's made a bunch of great investments around IDC, and we had Virtu go public, and we had Instinet, which now powers NASDAQ. We're investors in NASDAQ. And I use it to really if you talk to an oil and gas company, they think they're a technology company. If you talk to a retailer that's not Amazon, they've become a technology company. There's a great article on Walmart recently.
They're paying, at the very least, they're paying very careful attention.
Yeah, and if they don't use these tools and identify their customers and go to market with technology, they ultimately, and that's where our positioning as an organization has really been transformed over the last 5 years.
Now, aside from some debt investments, Silver Lake is almost completely absent from investing in these venture-backed private unicorns in the Valley. Why?
There will be a time and a place. It's not that these are great businesses.
Great businesses that you've chosen not to invest in.
And we like to be able, and this is the part where we are constrained by financial logic and linearity. When we sit with our limited partners and explain Alibaba, we're able to talk about all this wonderful market potential and all this opportunity. But the reality is we invested at 0.6 times free cash flow to growth. That's what it is. It's probably the best multiple we set up. We invested at Skype at 0.7 times free cash flow to growth. We're a little bit of financial weenies. We've,
Did you say weenies?
Yeah. We've
You're
never
chickens.
been. Yeah, our loss of capital ratio in firm history is 3%. We get paid to hit singles and doubles, steal third, come home on a pass. Every once in a while, the bat finds the ball and goes out of the park. But if we have a business of not building a portfolio, and venture guys think about it in a fundamentally different way. And the risk is if you start investing in many businesses that have big values, high growth, they're investing for future growth, but maybe losing money or a lot of money. If you get caught in a different cycle, you end up in a different place. And we just have made the decision in this environment with what's happened with valuations over the last handful of years, and it's really really picked up over the last 2 to 3 with new entrants in the market. It's not a priority for us. We have a robust enough opportunity. And it was actually 3 years ago up here I was talking about $1 of cash flow in a large cap technology company is fundamentally mispriced. And I still think it is in some cases relatively to where interest rates are and to where the average equity yield is across the overall market. And you can look through, I'm not going to name names, but you have to be a stock picker in this environment. But there are many places where companies have many great assets embedded in them and they yield double-digit, high single-digit, unlevered yields of cash flow. If you own a share, you get 8, 9, 10, 12, 15 cents on the dollar back. On a relative basis, we see that opportunity as being a better risk-adjusted return opportunity for us as it makes tech. And then the tech-enabled opportunity, as we wade into it, is starting to feel kind of unlimited. And now it's all about selection and where we really want to put our resources and time behind.
So 2 observations regarding this unicorn list. One is that a fair number of your competitors are investing in these companies right now. Second is, you're the ones in Silicon Valley. You're the ones who have the closest, most informed, largest staffed opinion of these companies. So are these, am I making interesting observations in your opinion?
Yeah, look, I think if I could buy the index, and this is how we talk about it, I'd buy the index.
Dan framed it that way.
If you could buy every private company for $350 billion and get everything, that's probably a pretty good trade today on a relative basis. But you may only make 2 times your money, or 2.5,
because
or 3.
some will be such spectacular failures.
Yeah, there'll be several of these companies will come and go. It's called technology. I mean, there are winners and losers. This has been going on longer than I've been alive. So, this is going to go up and down and ebb and flow, and in different markets. When the market feels like this, you have lots of liquidity. Our observation, though, is when the equity markets start to go down, the capital for the private company, high value, high growth, not making money, the corresponding asset value depreciation goes down at a much greater rate. So if the market drops 10 to 15%, the private market valuation goes from down 30% to no bid. And it happens really quickly and abruptly.
And so just to repeat something you said a moment ago so that everybody heard what Egon said, regarding this list, you said for Silver Lake, there will be a time and a place.
There will be a time and a place, and we've done it.
What's an example?
We did it with Alibaba.
Alibaba.
Would be a perfect example.
Egon, very last thing. When I wrote the article about Ari, I think 2 years ago, you told me that although you are Ari's boss and the representative of the owner of his company, that he calls you and gives you lists of things to do. Is he still doing that? Ari's
changed how I think about working with CEOs in a pretty fundamental way, and it helped me actually a lot. Have the relationship I have with Michael, which is we talk, email, or text pretty much every day, and a lot more than that. We have discrete projects we engage in, and we don't do a lot of these big formal board meeting things with big presentations that feel very Dilbert-like. The people who are touching it know it well and inside out. Financial reporting is different, and it's actually the same rhythm and operating pace, and you've heard Michael comment about it. We've changed all of the board friction at his company, and again, we're working with him on projects. And Ari and Patrick's energy is extraordinary. I mean, these are guys, when they bought William Morris, I'll do this for Ari. I mean, literally, they had a company that was losing money. To this year, we should do in excess of $400 million of EBITDA, and I actually haven't seen that much. And they've done it not by inventing something new, but with winning 1,000 small battles with a ton of grit.
Average duration of your phone calls with Ari Emanuel?
Short.
10 seconds, 15 seconds?
90.
90 seconds.
We have pleasantries.
Egon, thank you.
Thanks. Thanks, man.